Welcome back to Investing Talk Podcast.
Today we're looking at Vision Marine Technologies.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Vision Marine Technologies. What we're seeing here isn't just, incremental growth. It really appears to be a company executing a fundamental structural transformation.
A total shift.
And it seems to be driven entirely by a recent, very large strategic acquisition.
That's really the whole story, isn't it? We're trying to figure out if they've successfully pivoted from being this small, specialized boat manufacturer into something much, much bigger.
Something more integrated, yeah.
And the numbers, they just jump right off the page. When we look at the top line for fiscal 2025, revenue hit $19 million.
$19 million. And you have to put that in context. The previous year's revenue was what? $3.76 million?
Right. So you're talking about a 404% increase. That's not normal organic growth.
No, not at all. That is a complete re-rating of the business. And it really all comes from one place, the Nautical Ventures acquisition.
Okay, so that's the catalyst.
That's the one. That deal closed mid-year, June 20th, 2025, and the impact was, well, immediate. Since that date, that one segment alone has generated $12.8 million in revenue.
So wait, in just a couple of months, the new part of the business made multiples of what the entire old company made in a year.
That's it, exactly. It's a massive transfer of power within the organization. But the most crucial figure here, and this really dictates the whole investment thesis going forward, it's the margin.
The gross margin.
Right. Nautical Ventures brought in $4.7 million in gross profit. That translates to a, frankly, phenomenal gross margin of 36.8%.
Hold on, 36.8, that seems really high.
Yeah.
For context, traditional boat dealerships, they rarely clear the low 20s.
That's a necessary challenge, yeah. And look, some of it might be an initial bump from favorable inventory sales right after closing, but the sustainability comes from their product mix. Nautical focuses on high-end, specialized marine products. It's not a volume game for them. This margin is why the acquisition was strategic. It gives them a high-margin cash engine.
Okay, so that 36.8%, that's the anchor for the bull case. But let's not forget the other side of the ledger.
Correct. Even with that performance, the company is still reporting trailing 12-month net losses. We're sitting at negative $11.63 million.
So they're still burning cash overall.
They are. It shows the strain from the legacy operations and, of course, the integration costs. But that retail segment's outperformance, well, it signals the clearest path they have toward eventual profitability.
And it seems like that retail engine is already picking up speed. We saw them have, a 40% year-over-year sales lift at the Fort Lauderdale International Boat Show?
At FLIBS, yeah, a huge event. And they've sold 166 boats since the acquisition date. It points to real accelerating demand feeding right into that high-margin segment.
Okay, so the picture seems pretty rosy. Why then, when you look at the analyst outlook, are they forecasting a contraction for next year?
Yeah, that's a key point of caution. Analysts are expecting $3.88 million this year, but then a drop down to about $1.43 million next year.
That feels like a huge disconnect. Is the street worried about a recession hitting boat sales?
It's less about a market worry and more about integration reality. It reflects the really high upfront costs of stitching a massive retail network into their manufacturing framework.
So staffing, tech upgrades, all that stuff.
All of it. The market believes they're prioritizing structural change, which is expensive upfront, and that drags on the near-term forecasts.
It's like they're gutting the house to build a huge extension. The construction phase is messy and costs a ton, but the finished product could be worth a lot more.
That's a great analogy. And that brings us to what that finished product is supposed to look like. This is where it gets really interesting. They're building a competitive moat.
Through vertical integration.
Exactly. They are taking their proprietary eMotion electric propulsion tech, that's their core IP, and combining it directly with that established Nautical Ventures retail network.
So they're shifting from just being a component supplier, hoping dealers pick up their engines, to controlling the whole process.
The entire supply chain, from factory to end user. And what that does for the customer and for the competition is it creates incredibly high switching costs.
So it's the Apple model, right? Once you buy their electric boat, you need their certified service, their storage. Moving to a competitor becomes a massive headache.
Precisely. It's a high-end, specialized walled garden for electric boating. And we're already seeing this in action. They've secured exclusive distribution rights for other electric products like the Taiga personal watercraft in Florida.
And what about the physical locations, the marinas?
Even more important for stability, the Anglers Avenue Marina acquisition is expanding to 300 slips. And marina slips, that's stable, recurring revenue. It's a great balance for the cyclical nature of boat sales.
Which brings us to their financial health. Managing the balance sheet after a deal this big must have been a huge concern.
A primary concern. And they are actively deleveraging, which is a major signal of management efficiency.
Let's put some numbers on that. They reduced their floor plan financing. That's the debt on the inventory in the showrooms.
Right.
They took that from $42 million at the close of the deal down to $22.1 million as of late November.
It's a staggering reduction in a very short time. It signals they're either selling through inventory like crazy or just aggressively paying down that debt. Either way, it's a huge weight off their balance sheet.
And that's essential when you're still running those net losses. There are also a couple of things helping their future cash flow position.
Yeah. Right, the mitigating factors. First, they expect annual savings of $1.6 million just from location consolidation, cutting overhead.
Second,
They have a big $6.6 million real estate receivable coming in. That's a guaranteed non-operational cash infusion.
so if you connect the dots, that $1.6 million in savings and the $6.6 million receivable, they're like internal shock absorbers.
That's the perfect way to put it. It gives them the breathing room they need to digest all these integration costs.
Okay, so that's the fundamental story. Let's pivot to the market. Are investors actually buying this story yet?
Well, looking at the technicals, the market seems to be paying attention. After the fiscal 2025 results came out, we saw this big spike in volume,
How big?
over 3 times the 20-day average. That kind of volume suggests accumulation, maybe some institutional interest right after the results validated the thesis.
And the price structure itself.
It's interesting. While the stock has been, punishingly low, it is building some constructive patterns. We're seeing higher lows right around that $1.25 support level. It looks like a solid base.
So there's a floor, but it's still technically in a downtrend.
For now, yes. It's trading below both the 50-day and 200-day moving averages. So the technical picture looks rough, but that's countered by one very, very strong signal.
And that would be the relative strength index, the RSI.
The RSI, yeah. It's
Yeah.
sitting at, get this, 13.72.
Wow. Anything under 30 is considered heavily oversold.
Deeply oversold. A reading this low suggests the market has just hammered the stock, maybe too severely, given the operational improvements. It creates a strong potential for a technical reversal.
The classic coiled spring scenario. The fundamentals are improving, but the chart is screaming too cheap.
Exactly. And the general market perception seems to be turning bullish, driven by those concrete announcements, the marina expansion, the Taiga partnership, the debt reduction.
And what about the professional analysts?
The consensus reflects that long-term belief. The high average price target we're seeing is $10.20.
$10. I mean, that is a massive jump from where it is now. Is that realistic, or is that just analysts pricing in a perfect execution scenario?
It is certainly ambitious, and yes, it is based on the successful realization of this whole vertically integrated model. But if they prove that 36% margin is sustainable, then a $10 valuation starts to make sense. But
that requires perfect execution, which leads us straight to the bear case.
let's talk risks. Number one, you have that persistent net loss of over $11 million. They can't burn cash forever.
Right.
Number two is that forecasted revenue contraction next year. And number three is just execution risk. We saw the stock drop nearly 19% on the initial marina news.
Which highlights how sensitive the market is to any hiccup. If they stumble on the integration or the cost spiral, the stock will get punished.
Severely. But again, they do have those mitigating factors. That high retail margin, the $1.6 million in savings, the $6.6 million receivable, those are the financial buffers.
The shock absorbers.
Exactly. And looking forward, there's a pretty clear calendar of catalysts to watch. Continued sales follow-through from Fell Labs, racing sponsorships to build the brand, and hitting those physical marina expansion milestones.
And what about the more speculative stuff?
Well, there's chatter about a potential $2 million Florida grant receipt, which would be fantastic, and maybe further M&A, like another marina purchase.
But the real test, the big one, is coming up soon.
It is. The target horizon for this whole thesis is the Q1 2026 earnings report. That's the checkpoint. The market will demand to see progress on debt reduction and growth in that recurring marina revenue.
So To sort of wrap this all up, what we're really watching is a traditional manufacturing business trying to pivot, and pivot fast,
Yeah.
into a vertically integrated retail and services model.
A complete pivot. They're leveraging their electric IP to build a proprietary ecosystem in a huge market. They're moving away from just selling an engine to selling a whole experience.
The key takeaway then, for you, the listener, is can they do it?
That's the whole question. Can they translate that impressive 36.8% gross margin from the retail side into overall company profitability, all while managing these huge integration costs and their debt? If they nail that execution, the potential is there for a powerful snapback.
A fascinating story of a company attempting a fundamental shift in a really high-growth sector. If you enjoyed this analysis, remember to subscribe for more insights on the companies shaping tomorrow's market.